back at the 3 months between October and December, the market had a good rebound in October and November, and this was really on the back of expectations of inflation moderating, which could lead to slower rate hikes by the Fed. However, the market fell in December after the Bank of Japan's surprise announcement to make tweaks to their monetary policy. This was viewed as an effective rate hike. As a result, in December, it was really macro that took over micro in terms of stock movement. During this period, the return for the trust was flat in sterling terms, while the benchmark topics rose 5%. Stocks such as insurer Tokio Marine and furniture retailer Nitori that benefit from higher rates or stronger yen contributed to returns. But these were offset by our underweight position in financials, in particular banks, and our holdings in real estate that fell on concerns over higher rates affecting their businesses. However, we believe that the impact of higher rates on the earnings of the real estate holdings that we have will actually be limited. In terms of portfolio activity during the period, we added 4 new names and took 4 out. And this resulted in a total of 69 stocks in the portfolio. We exited a couple of stocks that we have held for a number of years. This includes architectural CAD maker Fukui Computer, which had benefited from government IT subsidies in the recent past. In terms of initiations, we added Mitsubishi UFJ Financial Group. It's one of the 3 mega banks in Japan. We believe that the company has become more committed to a disciplined and shareholder-friendly approach to capital management under the current management team. And at the broader industry level, we had been concerned about the negative interest rate policy put in place by Bank of Japan, but we are starting to see signs of change in terms of monetary policy, which is likely to improve the outlook for the industry going forward. We also initiated Hitachi, which is Japan's leading industrial group. They have gone through a restructuring over the last decade, and this led to an expansion in margins and also a portfolio that's more resilient to various business cycles. We expect further improvement and growth in the business in areas such as power grid business. So they have the world leading technology for reducing power losses during transmission, and this is very important for renewable energy, given the transmission involved and the distance of transmission that's involved. So they stand to benefit from greater adoption of renewable energy sources around the world. They also have what's called Rumada. It's an Internet of Things platform, and as well as digital product engineering business. And these businesses are well positioned to capture rising digitalization demand for plants and infrastructure around the world. Before I talk about the outlook, let me just look back at 2022, because it was really a year of many moving parts. Throughout the year, we saw interest rates being raised across the world, particularly US, and this had implications for forex as well. We saw yen weaken from 115 at the beginning of the year to 150 towards the middle of the year, and right now it's around 130. So it was really a volatile market year for forex. And just add, we had lockdowns in China, which led to logistical issues, bringing products in and out of China, which led to component shortages at many of the holdings in the trust as well. And cost inflation was another. We saw commodities rising. Oil was at one point rose 40%, and this had cost implications for many of the holdings. Even though they have pricing power, some of the cost changes we saw were significant and too quick to catch up. So if you look at what did well in the market last year, it was really those that are exposed or beneficiaries of rates and commodities. On the flip side, the better run companies that we hold, in normal times, they are well positioned to be able to meet these types of macro headwinds. They have globalized vacations, operations, they have pricing power, so they're able to pass on cost inflation. But even those with strong market positions, with pricing power, and some with more inelastic demand, they were not able to raise prices quickly enough just because of the fast changes in macro, or they just didn't have enough components to be able to complete a product and sell or ship to the customers, even though the end demand remained firm. So it was really a macro over micro. But if you look ahead, we are starting to see signs of some of these trends reverse. So commodities appears to be easing in some areas in terms of prices. Rates, the pace of rate hikes seems to be slowing in some markets, which also means has led to stabilization of forex compared to last year, and also reopening in China and Japan. So we are already starting to hear from some of our holdings that after a difficult months in December in China with the spread of COVID infections, they are already starting to see some of these things normalizing. So component shortages easing, it's becoming easier to ship products in and out of China. And we know that the better or the well-run holdings, the companies that we hold, they've been preparing for potential recovery in end demand and some of these supply chain issues. So we believe that in this environment, they are well positioned and they will do well, especially when some of these trends start to, or some of these trends reverse in a more meaningful manner. So we believe that the trust is well positioned for what's ahead.